This is a bullish divergence as indicated by this indicator. This basically means that the price is most likely going to go up. If we were to take a buy position here, the trade would have been profitable. On the other hand, the same indicator indicated a bearish divergence, meaning there is a high probability that the price will go down. If we were to take a sell position here, as you can see, the trade would have been profitable. This is the amazing indicator I will share in this video. We're going to go over what this indicator is and how you can use it to trade based on divergences. Let's add this indicator to our trading chart. Now, to add this indicator to your chart, you want to go to TradingView, the trading platform that I'm going to be using. I will be using a 30-minute time frame of GBPUSD. But for the strategy I will explain later in the video, you can use on any trading security and on any time frame. After that, you want to click on Indicators. Here, search for Turbo Oscillator. It's going to be this one by Run Rocks. Add it to the trading chart. The Turbo Oscillator is a technical indicator designed as a comprehensive toolkit that combines multiple analysis techniques into one. Its main goal is to help traders identify trend changes and potential reversal points in real time by leveraging divergences, momentum, or volume signals, and other advanced features. One of the core functions of this indicator is divergence detection in real time. It identifies both classic divergences and hidden divergences as soon as they occur. A classic divergence occurs when the price action and the oscillator move in opposite directions. For example, for a bullish divergence, the price makes a new low while the oscillator fails to make a new low and instead makes a new high. For a bearish divergence, the price makes a new high while the oscillator does not make a new high, but instead makes a new low. The Turbo Oscillator is going to highlight these discrepancies in real time to indicate potential reversal points. Now, how about hidden divergences? Well, hidden divergences are the opposite of classic divergences. Now, let's go over what this indicator is made of. The first component we can see is obviously the classic divergence lines, which are these white lines. Whenever they're printed, they indicate either bullish or bearish divergences. The lines at the bottom of the oscillator indicate bullish divergences, meaning the price might go up. The lines at the top of the oscillator indicate bearish divergences. We also have hidden divergences, but for that, you've got to activate them in the settings. You just double-click on the indicator, or just open the settings from here.
Do you feel like everyone around you benefits from artificial intelligence, but you have no idea where to start? Don't wait any longer. Start today. Our free trading bot is simple to use, powered by artificial intelligence, and can earn you up to 1% profit every single day. Over 500 members have already joined. Click the link below now to get free access. This is your chance to harness the power of AI and take a step toward a financial boost.
And then, activate the hidden divergences from here. As you can see, they're going to have two colors. Green lines at the bottom indicate bullish hidden divergences, and red lines at the top indicate bearish hidden divergences. The next component is called the signal line. It provides insights into trend changes and price reversals. These dots on the line indicate the beginning of a trend shift. They can vary in size, offering a clearer understanding of the strength of the emerging trend. This feature works in combination with the RSI, the Stochastic, and the MFI, ensuring you capture every market movement accurately and promptly. The indicator also has the money flow histogram. This one right here. It uses an extended period, providing a more comprehensive and accurate analysis of market conditions. The money flow histogram can also be used as an additional confluence through divergences. Next, we have these arrows at the top and bottom of the oversold and overbought levels. You might be thinking, what exactly are they? Well, these are called predicted reversal zones. In cases of strong overbought or oversold conditions, the indicator detects potential price pullbacks and marks the beginning of a trend change. This helps better identify trend shifts. These reversal zones can actually be used as potential take profit points for your trades. Now, using this indicator to trade is as simple as this. Obviously, this is a super simplistic strategy just to showcase how this indicator works. The basic idea is to combine divergences with overbought or oversold conditions, as well as reversal signals for stronger confirmations. If you didn't already know, a market is considered overbought or oversold when these levels shift from gray to a bright red for oversold or a bright green for overbought. These arrows indicate potential reversals, and when they appear alongside divergences, it strengthens the signal. Now, for a buy position, condition number 1 is to identify a bullish divergence, which, as you can see, is right here. The price created a lower low while the oscillator created a higher low. Condition number 2 is that the market should be extremely oversold, and that is going to be indicated by the bright red color on the oversold level. Condition number 3 is that you want to have a bullish reversal signal, either aligned directly below the divergence or in between the divergence and the tiny dot at the end of the signal line. The green arrow should appear instantly or somewhere in between. If the arrow is printed before the divergence, the signal becomes invalid. As you can see, it's now aligned with the divergence here, so our condition is met. Keep in mind, these divergences are delayed by 2 candles, so you can't just enter the trade on the exact signal candle. If you were to use a bar replay, you'll see the divergence is only printed after the signal line shifts from red to green, and a trend shift signal, which is a tiny dot like this one, is printed at the end of the signal line. Once these conditions are met, you take your buy position, place your stop loss comfortably below the most recent swing low, so it has enough room. And since this is a reversal type entry, you can go for a larger take profit, such as 2.5 times the risk, letting the trade run, and as you can see, it was profitable. Now, let's take a look at a sell position. For a sell position, it's going to be the opposite. Condition number 1. Check that we have a bearish divergence. Here is our bearish divergence. Price established a higher high between this high and this high, while the oscillator established a lower high. Condition number 2. Check if the market is overbought immediately after the divergence, indicated by a bright green color on the overbought level, which, as you can see, we have it here. Then, you want to look between the end of the signal line and the dot marking the end of the divergence label, either exactly on this dot or in between here and here. There should be a red bearish reversal signal. Right now, as you can see, it's in between, which makes it valid. We enter a sell position, place a stop loss above the most recent swing high with some breathing room, and the take profit is going to be set at 2.5 times the risk. By understanding all the components of this indicator, from divergences and the signal line cues to volume histograms, traders can fully harness the Turbo Oscillator. If you found value in this video, remember to leave a like or even consider subscribing to stay tuned. Thanks for watching, and see you next time.